Ray Dalio made a statement somewhere to the effect that the next 5 years are going to be far more dramatic than anybody anticipates. And I think he implied negative dramatic. And he also, at that point in time, had a sentence that was quite good that says, quit looking at the price of your stock or the value of your stock. Look at the value of the underlying money in it. Okay, that's the reality. Your stock might go up 10% a year, but you're not making any money if the money supply is going, et cetera. Okay. Anyway, we think we're in a situation historically, politically, economically that we've never been in the U.S. before in modern times. We think there's been a stock market bubble of dimensions we've never seen before. You go back and look at 1923 to 29, 1995 to the dot-com top, let's say the 2002 bear low to the 2007 peak. These were all like doubles and triples in the S&P 500 and so forth. We just had a 7-fold increase in the price of the S&P from 2009, a 16-fold increase in the NASDAQ 100. Okay. And if you look at an M2 chart, you can see just explosion. And if you look at it at the same time, Fed funds chart, it just went, laid on the mat there. Free money, free money, free money. Okay. So it's easy to understand why those bubbles occurred. So it's somewhat logical that when they come unwound, if and to the extent there were errors made by corporations, families, investors, government spending, et cetera, based on the assumptions of free or cheap money, cheaper than reality. Okay. And long-term commitments were made based on that. Again, could be portfolio, could be corporate planning, et cetera. And you're wrong. And it turns out, oops, we're wrong. Money didn't stay cheap. And all of a sudden, it's like ripping a bandage off of a huge sore. And I think that's now accomplished. The Fed has done that. And so now everybody's very hopeful again. Well, there's certain events that people aren't looking at. And that's political chaos type events.
Michael Oliver is suggesting that we're living in a deeply divided country, a reality that's been clear for years. He points out that it's no longer just about Democrats and Republicans taking turns in power while following the same playbook of growing government, increasing taxes, and piling on debt, regardless of who's in charge. Oliver believes most market participants are missing the bigger picture. They're still focused on traditional metrics like earnings, interest rates, or Federal Reserve policies, as if the market is simply at a typical top or in transition. But according to him, they should be paying closer attention to political upheaval, which could significantly disrupt the status quo. One example he highlights is the growing push for alternatives to central bank control, like Texas' proposal for a gold-backed cryptocurrency. If something like this were to materialize, it would essentially be a form of economic secession. By introducing a currency immune to manipulation, one that can't be inflated or deflated at will, such a move would challenge the Federal Reserve's monopoly on monetary control. Oliver suggests that this could weaken both the central banks and the federal government's grip on economic power, opening the door to profound systemic change.
Well, Alaska has also, I believe they've actually passed it. A state, the legislature's passed this, a rule that says gold and silver are legal tender in the state of Alaska. They're not a commodity, they're legal tender. Well, that in effect is secession as well. And if the political division continues, which we think it will, then some of these things are going to happen. And so all of a sudden, instead of just the econometric metrics that you should be looking at, there's the political divide with in the street type ramifications. It's like 52 card pickup. All of your notions of what's normal are gone. You have to rethink the whole thing. And in that sort of environment, and I think that's why gold is doing what it's doing, not just because it knows that if the bubble bursts, the central banks will have to bail it out because they have to come in and save the municipalities, the state governments that can't afford to pay their policemen and their teachers, et cetera, pension funds in jeopardy. Add this to the mix. If the market rolls over, and we think it will, it's primarily led by 5 or 6 stocks. Anybody with a brain realizes that if you look at the NASDAQ 100 or the S&P 500 and want to explain the last 3 or 4 months of advance, if you take out the top 5 stocks, you won't have that advance because they're all, it's 50% of the NASDAQ, 30% of the S&P, and that's what constituted the entire move. But if that rolls over again, and it's associated this time with actual pain, like dropping metrics, unemployment suddenly gets worse. people have a sense of, oh my gosh, all my hopes that I had because of that rally are shot. I was wrong. That will be emotional, and that will add to the fire under the feet here. If and when, and I do think you're going to get it, a rollover in the stock market again, I think that will be an emotional igniter that gets things hotter quickly. And so I'm looking for some markets, in particular gold, I think, and silver. If there's more upside, I think there's a lot more. We go through the highs in gold. So you're at a triple top trying to punch through. So if we burst through that barrier, and I think we will, because I think it's been a benign correction, I think what comes on the other side will be more ballistic, more chaos theory. And I suspect that it'll be somewhat correlated to a rollover in that major asset category, the stock market, and a flow of assets, again, out of that category into a safe alternative. So something's being said there. And I think the fact that they now rush back to their highs, especially gold back to its highs, also says something.
Michael Oliver suggests that the current trend in gold signals a significant shift, with money flowing steadily into gold from other areas. This isn't just a gradual movement. He believes we're entering a phase of chaos theory, where more dramatic and ballistic moves take over, leaving behind the incremental changes of the past. According to Oliver, gold has essentially divorced itself from traditional market influences, a fact that smart money, like Ray Dalio and other prominent portfolio managers, has already recognized. Oliver draws parallels to the late 1970s, a period marked by global stagflation and recession, during which commodities soared and gold and silver exploded even more. He argues that this time, the impact on gold and silver will be even greater. The underlying driver, he says, is a monetary event. Central banks, facing mounting pressures, will inevitably shift their policies. If troubling data emerges, such as declines in the financial sector, they'll revert to their default playbook, monetizing debt and printing money. Gold, understanding this dynamic, is already positioning itself for the aftermath. In Oliver's view, gold will thrive in this environment, even during broader market downturns. As for miners, he acknowledges their current weakness compared to gold and silver. However, he points out that miners historically exhibit a slingshot effect. While they underperform during corrections, they tend to dramatically outperform gold when it makes a decisive breakout. He believes that once gold convincingly breaks its all-time highs, even skeptics will take notice and miners will surge, leaving gold itself in the dust.